Central banks are like umpires in cricket. If nobody is talking about them, it means things are fine. It means they are doing a fine job. But if they are on the front page, rest assured something is wrong. Today is one such day. Everybody is talking about the US Federal Reserve. Why? Because the US inflation data is out. We'll start with those numbers now. Consumer prices increased 8.3% in August. Compare this to the months before. In May, it was 8.6%. In June, it was 9.1%. And in July, it was 8.5%. So compared to that, the August numbers are less. Having said that, three problems remain. Number one, the market expectations. Experts were hoping for 8% inflation in August, but the final data is much higher. It is 8.3%. Number two, month-on-month inflation compared to July. America's consumer prices surged 0.1%. It was unchanged from June to July, but in August it surged 0.1%. And finally, problem number three, core inflation, meaning that consumer prices minus the volatile stuff. I'm talking about things like food, fuel, things that affect all of us. America's core inflation actually increased 6.3% in August. Both June and July posted around 5.9%. So considering these three factors, America's inflation data is not so impressive. Yet, it is lower than July and June, but still too high for comfort. And that's where the Federal Reserve comes in. Later this month, America's central bank will unveil its next policy move. Now, the market expectation was clear. They wanted some relief from the interest hikes, but with the latest inflation data, that's not happening. Chances are there will be more interest hikes. Experts are split between two options. Either a 75 basis point hike or a full 100 basis points hike. Either ways, it means one thing alone, that economic growth will slow down. On Tuesday, US markets reacted sharply to this piece of news. The Dow Jones closed 3.9% down, Nasdaq closed 3.5% down, and Standard & Poor's closed 4.3% down. Clearly, the markets are expecting a downturn. You see, when central banks hike interest rates, there is a chain reaction of sorts. Lending comes down, spending comes down, jobs disappear, and the economy as a whole slows down. The next big question, what is President Joe Biden's plan to tackle this? Well, on Tuesday, he was taking a victory lap. He invited lawmakers, cabinet members, activists, and interest groups to the White House. What exactly was he celebrating? The Inflation Reduction Act. Last month, Biden passed this legislation to tackle rising prices. It is expected to cost around $430 billion. And yesterday, he celebrated it. Well, talk about poor timing. While Biden touted his massive spending bill, the U.S. inflation data trickled in.
Exactly 4 weeks ago today, I signed the Inflation Reduction Act into law, a single most important legislation passed in the Congress to combat inflation and one of the most significant laws in our nation's history, in my view. I said it then, and I'll keep saying it. With this law, the American people won and special interests lost.
Now, let me tell you how all this affects the rest of us, the rest of the world. How does U.S. inflation data affect us? Let's look at Asian markets first. India's Nifty closed 0.3% down, so marginally in red. Japan's Nikkei closed 2.8% down. South Korea's Kospi 1.56% down. And the Shanghai Composite 0.8% down. So Asian markets are spooked by inflation data. But how exactly does that work? How does US inflation affect countries like India? Because of two major reasons. Number one, the strengthening dollar. India is an import-dependent country, which means if the dollar gets stronger, we end up paying more. And this is called imported inflation. And right now, things are headed that way. The rupee is trading at 79.4 against the US dollar. Experts say it could slip below 80 or even 81. If that happens, India's imports will become more expensive. Let's now come to reason number two, a capital exodus. When interests rise, investors move away from volatile assets. These could include equities, cryptocurrencies, and commodities. In other words, there could be a sell-off. So how should India tackle this issue? Frankly, it's a tricky decision for the Reserve Bank of India. Let's look at the data first. India's wholesale inflation slowed to 12% in August. It was almost 14% in July. At the same time, retail inflation quickened. It was 6.7% in July. But last month, it increased to 7%. So the market is sending mixed messages to the RBI. Another factor to consider here is economic growth, of course. India's GDP grew 13.5% in the first quarter of this financial year. Sustaining that growth is now a priority for the government. So which way will the RBI go? That depends on a lot of factors. If the RBI does not hike interest, there will be more imported inflation. The rupee could slide further. It could also trigger an exodus from the Indian markets. But if the RBI does hike rates, growth will suffer. Right now, experts are predicting the second scenario, a rate hike, perhaps a 50 basis point increase. But the central bank also faces subtle pressure from the government. Last week, Finance Minister Nirmala Sitharaman dropped a few hints. She said the RBI had to be more synchronized to handle inflation. And that's the worry for India. Runaway inflation could be a major problem here, especially with 200 million people below the poverty line. So is the prospect of stalled growth? The Indian economy has to create jobs for its youth, and that means monetary loosening. So the RBI faces a tough decision at its next meeting in late September. And this is a story that we will keep tracking. WION World is now available in your country. Download the app now and get all the news updates on the move.